today to attend the Black Swans Summit. I'm not making up, that's the name of the summit. It's called the Black Swans Summit. So what a better way to start the discussion than showing you the real black swans. This is not a technical post. In fact, I promised that I'm going to do a friendly post from Western University. So this is just a short note, so we can all enjoy some friendly sounds from welcoming black swans. But more seriously, some of you might be interested to know that when the white folks came here, they were surprised to find black swans. In fact, maybe even those of you in science, you might want to check this, but in Europe, apparently they used to believe that there were only the other color swans, and here we are. Just be trying to be lighthearted about this story, I guess. But more seriously, I'm going to write and share some notes with you about why I'm here, what's the future of money, the fintech industry, and so on. So stay tuned.
You're actually talking to your audience more. Brian Armstrong.
Firstly, stepping in on behalf of my Birya, my elder, Richard cannot be here today, and he's passed on the role, responsibility, and respect process that comes with delivering a welcoming country in this space. For those that are new to this area, for those that are international, interstate, regional, this is a process we go through to welcome you into this space. And for those that have been here for many years, many generations, this is a process of blessing. This is us asking our good Kanya, our good spirit, to look out for us while we're here. We always open by saying, if you're a spiritual person, you're welcome to tap into it in that way, take those good energies. If you're not a spiritual person, respect being our greatest asset. It's available to each and every one of us. It's free. This is for you as well. You can tap into those energies in any way you would like.
which are multiple physical qubits grouped together to encode information such that we can do error correction and fault tolerant computing. Before last year, I was not dreaming to have this so soon. So it exceeds my wildest dream. By far, yeah.
So just to I understand what you're saying clearly. Today, in normal machine, normal computer which people are using phone, there is a lot of error in the machine. And there's a software which is constantly correcting those computational error in normal machine. Normal phone, computer. That software which constantly corrects that error in normal computer is still not that smart when it comes to quantum. And you are saying that software which is constantly self-correcting the computational error has improved and the error rate has gone down. Is that what it means?
Yeah, exactly. Actually, it's black and white. I mean, before 12 months ago, no one has been able to create a single logical qubit, which would, yeah, you can treat it as a qubit to do computation without worrying about the error.
Yes.
So the last 12 months has seen enormous progress in multiple platforms.
Because just to ensure the audience get what I'm trying to say, that today a machine makes mathematical error. And we have constant upgrade happening to the machine to 2 multiply 2 equal to 4. In a normal computer, after many computation can be something else, but the system knows how to fix it. And we got it now right. How right? Is it close to the normal computer error rates?
It's speaking there, what I want
How
to
big
say.
is that? Yeah.
So our computer works magically. Every time you type in something, you expect
2
same
multiply
kind of
2
answer.
equal to 4.
That's right. And then it's based on, by and large, redundant copies. So instead of 1 bit, you use 3 bits. But quantum mechanically, you cannot copy. There is no copy.
It's a straight thing. The straight
That's
thing.
right. You cannot copy, you cannot look, because the quantum states just collapse. Therefore, it's a really, really fundamental challenge for the community.
And maybe that's the time to bring the basic question, what is quantum?
Okay, yes.
Because you talk about what I'm understanding, you're telling that because the state of the outcome changes, quantum becomes exciting. Explain that.
Yeah, it goes back to a long time, right? Yeah. So quantum theory is not new. Quantum theory has been here for at least 100 years. This year is actually the International Year of Quantum, celebrating 100 years of progress in quantum. So there's a first quantum revolution, which created the laser we all use, NMR, GPS, you name it. The modern technology actually underpinned by quantum. So that's what we call a first quantum revolution. So what's so new now suddenly? We are basically experiencing the second quantum revolution. The main difference is now we can manipulate a single photon, single atom, single electron, it's just beyond mind.
I saw that in Zurich, a single atom.
Right. That's right. So the most exciting development happened roughly 12 months ago is by this quantum computing company called QWA. That's a spin-off company from Harvard and MIT. And they use atoms. So they have lasers shining towards each other, form standing wave. And therefore, standing wave has high and low energy areas. So the atom, if you spread it in, it will have one atom at each side. It's just unbelievable. It's rubidium atoms, they manipulate really at that level. They can control exactly where that atom will be and how to interact with the neighboring atom. And by 256, we managed to create 10 logical qubits.
But this reminds me of Bollywood movie. Let me explain this. In the world of quantum, there's something called entanglement. That exactly same behavior of an element is somewhere far, far away. In Bollywood movies in late 80s, every movie had twins separating when they're young in a big fair, and after many years they show up. One is a thief, other is a police. They look exactly the same, they behave exactly the same way, but they're different characters. I was told that's how quantum operates.
Excellent question. Sometimes people get very confused with classical correlation. In classical world, we have correlations all the time.
Yes.
A marriage couple, if it's divorced, it has to be both divorced, right? You can't have one divorce, not the other.
Yes.
That's a bad analogy.
Got it.
But all these quantum, all this classical correlation is not what we call quantum entanglement. Use a more physical kind of thing, like a black out and white hole. You put it both in a box. Without looking, you take one away. Without looking, because then you don't know what's the color of the ball left in the other box.
Yes.
But as soon as you look, the other one, is no. But that's classical correlation. That's predetermined. But quantum correlation is quite different. It's absolutely undecided of its states until you look at one particle.
So you can look at one particle
And another
predict. And that's what Bollywood guys figured out many years back in the movies.
Yeah, in the movies, I think it's because we are classical beings. People ask you, what's that for? I mean, what's the use of that? And then they look at many things and then suddenly find a new whole world. That's the start of microbiology. So quantum computer now let us to harness nature at the deepest level we ever know.
Yeah.
So to me, it's not just about computing. To me, it's to discover a whole new world.
So a lot of consulting companies, their revenue projection is based on telling banks to go to the new standards. So you are saying all this are not really that close to protecting the system?
It's not proved. There is no proof.
So we should not spend money with the consultants?
Right? Yeah. So if it can protect us for the next 50 years, I think we should do it. But if someone comes to me and says that this is bulletproof against any quantum solutions, I don't see the evidence.
Okay, I have a couple of minutes. From all the 2 minutes yours, tell us 5 good news about quantum.
Oh, yeah.
Or 3, whatever you take. It's all yours.
Yeah, as I just said, I think quantum computing as a new tool to discover, not to, we don't know. To me, the sky is the limit.
What problem will solve for?
So currently, I'm not a quantum computer hardware person. I'm leading a team developing quantum softwares and quantum algorithms to solve a whole range of problems.
Give me 3 problems.
Yeah. So first, we are currently devise algorithms to solve ODE, PDE, SDE. That's ordinary differential equations.
I have no clue. I don't understand what you're saying.
Okay, so basically, those are the fundamental equations to understand physical systems, chemical systems, biological systems, and financial systems. And
That I
anything, anything you can describe mathematically, it comes down to some kind of equations. And we are trying to find ways to solve that with higher accuracy and fast. So that's one.
Okay.
Yeah. So second, I would say a lot of applications is to do with optimization. I think in our life, every day we wake up, it's how to optimize the time, the effort, and money to achieve.
I love the money part.
Yeah, to achieve what we want to achieve. So quantum computing has been demonstrated to be able to help to find better solutions, high quality solutions, if not the best, but better solutions for those logistic problems, which permits every part of our life.
Well, we are done with our time. Do you think quantum is good for humanity? Yes or no?
I'm thinking about that a lot lately. The one thing I want to say is I don't want to help a few rich people richer,
Well, I'm not
a
that
few
rich.
powerful people more powerful. So that's why education, outreach, and to let people know what's available there. And that's our future. We should build it together.
Thank you, Prof. It's always exciting talking to you.
Forward to the conversations in the next few days. Let our goal be nothing short of audacious and bold, to apply the best of technology to reshape the financial system and financial ecosystem of the future, to become more efficient, more value-adding, and more inclusive.
Get resilient if you don't live in a risky environment and learn how to manage. I think balancing those risks with upsides and downsides is equally important. To me, when it comes to regulation, and I think this is a key aspect of Europe, Europe at the moment seems to be specialized in regulating the innovation of others as opposed to innovating itself.
Of the future of money, and so we're going to hopefully leave most of the time for them to talk. I just wanted to, for money, for the future of money, has already happened. It was 10 years ago. It was the creation of Bitcoin, which is the first kind of scaled solution to this very long-standing problem in computer science of the problem of digital cash, which is a kind of financial asset that you can control yourself, like normal cash. You can give it to other people without relying on another intermediary to facilitate that. But it's digital, so you can send it around the world. And so that, in a sense, was the sort of genesis of a lot of the changes we're seeing now in cryptocurrency, stablecoins, other forms of programmable money, digital assets. And you may have heard this before, that one of the functions of money is the unit of account. So you know, a dollar being a dollar, you can use that to sort of price things and advertise the price of stuff. And that's what central bankers, for example, call this concept of the signalers of money. They want a dollar to be a dollar all across the economy. The second function is money being a store of value, so that you can collect it and save it up for a purpose and then use it later on. And the third is money as a function, supporting the function of the medium of exchange. That is, you can use money in exchange for buying other stuff. So when I think about the future of money, I'm thinking partly about how does Bitcoin and other new forms of digital money change those
place to look into the future than Singapore. A place where fintech flourishes and where this festival brings the unlimited energy of fintech enthusiasts.
Those are two key benefits, right? Having additional trust on the tokenized asset, you get more transparency. So when it comes to, say, ESG assets, very, very important. You have a carbon credit. If you don't know what it represents, are the trees even still there? The ability to verify the information behind the asset is very, very important. And data integrity use cases are essentially made for blockchain because you can see in real time what's happening. Obviously, there is the need to reconcile the real world asset with the digital twin. Well, that's where one of the challenges lies. So for carbon credit, for example, we have an open source toolkit called Guardian OS, where you plug in your policy, you plug in your IoT data feed so that you can actually see in real time, whether it's a soil analysis or satellite imaging, you have access to that information. But you could also have carbon credits that are not made in that way, and they could be tokenized, but not with that level of granularity. Then they will actually fetch a lower price in the market, right? So there is this transparency actually comes with financial benefits, because a high quality carbon credit actually will have a higher price than a low quality one. So those are things that are very tangible in terms of benefits. You also have fractionalization, better liquidity. So that unlocks certain use cases. You can have more diversification of a portfolio if you can buy a smaller piece of, like, real estate, for example. So it is a step beyond what TradFi systems can provide. You're not reliant on a siloed database at one financial institution anymore, right? You can actually break those silos and let the information and the value flow.
Okay, so I hear that it's not a traditional finance approach that the data sits in one financial institution, but it's spread across a network of computers around the world.
In certain cases, it is,
yeah. And that provides the security and transparency, so that we can say that token actually represents something and everybody can verify it.
Correct.
And I think what tricky is the question you mentioned, how do we actually verify, and I maybe tell a little anecdote to our audience. I designed one of the first Unity in West Australia on blockchain and DLT business and tokenization. And as an experiment, we invited guests, and I used to give them a bottle of wine as a thank you token. And I actually turned that bottle of wine into a token. I tokenized the bottle of wine and sent that token to one of the engineers to collect his bottle of wine. He never collected it, but the bottle of wine was in my cupboard for a long time. But he had the token, and if he did it himself or passed that token to someone else, they could come and claim the bottle of wine. By accident, 1 year later, I opened the bottle of wine and drank it. So yes, the person has the token, but effectively they cannot do anything with that. So how do we overcome that question, that challenge of the disconnection that you mentioned between the digital world and the real world? How do we explore that? How do we overcome that challenge from the technical point of view?
I guess there's two ways to do it. The one way is, especially if you're looking at a physical asset like wine, like you can actually put a sensor on the cap, and if your wine has to be valuable enough that you want to do that. But so you can't really do that at scale, except for like really vintage high value loans. So you could do that from an IoT perspective. And IoT blockchain are really good.
Internet of Things, so sensors.
Exactly, sensors. The other option for more intangible assets are to have the assets be born on chain, to be digitally native, so that there is no physical security to like settle in the background, for example, so that your house title is already digitally native. Then if you own the title token, then that means you own the house. So those are, either you take care of the disconnect between reality, the physical and the digital world, by adding data streams and verifiable data, or you remove that connection by just making everything digital.
Okay, we'll come back when we talk about real estate in a second, but I would like to know we move to Eli, because tokenization, what does it look like from a legal perspective?
So let me zoom out first. In Australia, securities laws governed by the Corporations Act. The Corporations Act defines financial products in a very broad way. It's got a broad definition, and then it goes to specific things that are included, like shares, and specific things that are excluded, like loyalty programs, for example. But the general definition is still very, very broad, so it ends up capturing many things that in other jurisdictions are not captured as financial products, are captured as financial products. That means that anyone who deals with it, anyone that has a market dealing with it, anyone who provides custody services relating to that has to be regulated, has to have an Australian Financial Services license that gives them authority to deal with it in a certain manner and comply with it. Now, when it comes to crypto, we don't have a bespoke regulation for crypto, but we have to retrofit crypto into the current financial planning system.
You're talking about Australia, or
Australia, this is Australia, right? So therefore, if we're looking at something like securities law, asset will prioritize substance over form. So let's say an ICO, somebody who's raising funds for a project, even though they may say they're selling a utility token, if the funds are to be utilized in a project and they give you effectively a right or a share to the project or to its earnings, it's probably a security, right? The same way with derivatives. If you have a token that derives its value off something else, it's probably a derivative, right? And will have to be regulated as such. Another one would be non-cash payments. These are things as substitute payments. So a lot of the stable coins arrangement that we see now, like USDT, USDC, if they were here, they would actually run as an issue in Australia, there would probably be some form of non-cash payment. And finally, the one that's probably that we see most often is a managed investment scheme. And those who've been following crypto regulation in the US, this is the famous Howey test, defining investment contracts from a US perspective. And that's really looking at three things. It's looking at did I promise, it's normally a platform making a promise saying, invest in me, right? I will manage that investment for you, generate some sort of return, and you don't have day-to-day control over that, right? That's a managed investment scheme, that's an investment contract. Either one of those arrangements triggers a financial product, and we have to have regulatory regulation for it. Now, when it comes to real-world assets, again, substance over form is what we care about. So when we're talking about real estate, if you're looking at the traditional market, you've got a house, right? Selling a house is not a financial product, right? There may be regulations around real estate agents and around property law, and all of that applies, but it's not a financial product, right? But once you have a real estate investment trust, where you're basically pooling a whole bunch of money and investing in real estate, that is a financial product. So in a similar way, when we're talking about tokenization, if there's a direct line through to the actual underlying asset, it may not be a financial product. But if there's some sort of pooling and you're managing it on behalf of investors, and they don't have control, that will probably be a managed investment scheme. The same with gold, for example. Owning a gold bar, not a financial product, right? But once owning a share in a mining company that's got a whole bunch of JORC-compliant reserves, certainly a share, right? And likewise, if there's some sort of scheme that has gold, but you don't actually directly, I cannot say that you own gold bar 155 and you own gold bar 6789, I cannot directly link that. There's probably some sort of managed investment scheme happening. Obviously, it's on a case-by-case basis, but that is sort of the general framework.
So I probably wouldn't get into trouble for my bottom line.
Probably not, but if you were selling that on a platform, you were selling these tokenized shares in that bottom line, and you controlled the bottom line and who gets a share and who doesn't get the share, then you probably are.
What about artists who create
the same thing? I mean, if it's directly, and again that goes back to what you were saying, is it art digital or is it off-chain, right? If it's natively digital, it's very easy to actually tie in the rights to the token, and you basically manage that seamlessly. And whenever it's off-chain, when you've got this piece of art, somebody has to manage that link. Somebody has to say, well, this Rembrandt is now owned by you and you. And that person, if they're managing this platform in a manner that's managed investment scheme, it will be a financial product. If, in theory, if they do it in a manner where they directly link that piece of art to each individual without pooling it, without managing it on their behalf, then they may not. But so it depends. Is what I'm saying.
Both of you mentioned something beautiful, the magic word, fractionalization. So that means I don't need to go and own that piece of Rembrandt or precious gold wine or a watch or a collectible car. We can fractionalize that with tokenization, and many people can own a fraction of that. So we can, I don't know if maybe as an academic to afford anything very good, yes. But I can afford small investment of $1,000. All right, so let's talk about the real assets.
Property, for example. So you could also use it, for example, to tokenize co-living places or rent-to-own models, for example. You know, so you can use it for different kind of models. Now, why utility was important for us in this case was that Blocksquare's goal is to create liquidity in an asset that is the most illiquid asset. Only 10% of all real estate investment in the world, the $300 trillion market, is actually liquid. The rest is done. And we created the way how we transfer value within asset-backed tokens. Our biggest goal was always that we can create secondary market trades. So today I can basically buy into a property, and then if I would like to sell my property token next month, I can list it actually on the same platform and invite other community members to buy it of me.
I hear. So imagine I want to go to a casino, not that I go, or to Disneyland, and I get a bunch of tokens. I swap my cash for tokens, and I can use any device in that space. Is that?
Yeah, maybe Disney.
Gives me access to.
Maybe Disneyland would have their own Disneyland token marketplace, and I can swap it with other Mickey Mouse fans, for example.
Ed, you have a different approach to tokenizing real estate in the United States.
Yes. Well, I look at it a little differently. We see the real estate in the largest asset class in the world, roughly $300 trillion of value. And when you look at that, about $75 trillion is actually investment in real estate. And so when you look at investments in real estate like hotels, apartment buildings, retail centers, and you look at the capital stack and what makes that up in terms of investment, about 26% of that is represents equity. And so the reason why real estate is an alternative investment is because that equity cannot be traded. So the only way you can get your money back is the asset has to be sold, and then you can get your money back, unless you're going to be a public REIT. And so I saw an opportunity when that $26 trillion being locked value could be unlocked using security tokens. And it's a big distinction. When you talk about utility tokens, that's one use of tokens. But when you're selling an investment product, you're talking about security. And so being able to securitize and also divide the equity in $26 trillion worth of value, you're now able to convert an illiquid asset into a liquid asset. It's almost like taking a building and IPOing the building like you IPO company. And so you can now issue shares to investors both in the United States or around the world who now own a fractional interest of the equity of that property, which is very tangible. So we were talking about how you directly tie it in. If you can tokenize $100 million worth of equity in a hotel, and by using the dollars as revenue, and issue it out fractionally in $10,000 units or $1 million units to different investors, they now they're able to control the growth of that asset. When the asset improves in value, they have capital gains, but also the dividends distributed from that asset. So it's purely an investment. And I think that's where we see a lot of excitement in the business, is because most people don't have access to high quality real estate. When I was selling real estate at Cushman & Wakefield, like I said, you roll next to 25 to 50 companies and things get dissipated pretty quickly. But now bringing the whole world to be able to buy those fractional shares is where I think it's a huge difference. But they are using security, so there are laws that we have to follow to make sure that in the United States the investors are accredited investors because they have wealth. But internationally, they don't have to be accredited. They just have to go through a KYC process. So that allows people in countries, even like Australia, to be able to buy high quality assets in the United States or in other countries around the world and create their own portfolio of liquid shares of real estate, which I think has never been done before. And so this really is an opportunity where sellers who normally own a hotel, their MO is usually buy the hotel, stabilize it, improve the value, hold it for a few years, and then sell it before the middle runs out, or renew it and sell it later on. But if they're able to pull their equity out of that property and still be the GP manager, they can hold that asset forever and still be able to continue to generate not only the growth of the asset, but also share the dividends that they're giving to the investors.
Okay, so the concept should become here, it's pretty much like owning shares in a company. But they are digital.
Yes.
So why is such a big deal with that?
not a big deal. I mean, like I said, we
Why
started.
haven't we done it before in the States?
Well, there wasn't a need for it before. You know, back 5-10 years ago when we first started this, we started in 2018, interest rates were low. Money was everywhere. Money's plentiful. You can borrow 2-3%. You can buy something at 5% cap rate. You're positive all day long. That has changed now. And so since that has changed, liquidity is very important. Without liquidity, people can't sell to turn around and buy. People can't sell to turn around and develop. So it freezes the whole market. So now being tokenizing these assets as liquidity, freezing it up, liquefying it, allows people now to get liquidity so they can continue to turn the flywheel, so to speak.
Okay, so you kind of democratize the opportunities.
Exactly.
That's brilliant. But it sounds like you're providing opportunities for high net individuals.
Well, we started off, trying to be altruistic to make sure that the lowest denominator of investor can buy into high quality real estate. That was really the purpose. But we realized that we have almost $9 billion of assets that are being tokenized, put on chain, and sell. And we realized that asking our small investors to put in 5,000, 1,000 from around the world, it takes a long time before they can get up to $2 billion, let alone $9 billion. So we had to start incorporating institutions, and now we realize institutions also want the benefit of liquidity. So when they buy a hotel and they put $20 million into one hotel, they can now take that same $20 million and diversify it into 25 different hotels. And still get that actually is a better investment because it lowers the risk because diversifying your investment that much more. But they also get the benefit of being able to exit when they want to exit. And that's a big deal for a lot of institutional investors. So we're going after those investors that write big checks, but we're also making security tokens available for the general public.
I hear that you seem to be having a different type of market, right?
Well, I think most people actually never have access to investment properties. If they even can afford to buy their own home, but then actually, like I said, to actually come to the level where you have the opportunity to go into investment properties, or do it for pure investment purposes, to build your passive income real estate and all that, that is for many out of reach. And not only, and I'm not only talking about like certain countries or something, I'm talking about Australia. More and more people can just not get into real estate anymore. So fractional ownership in investment properties is definitely something where they can start building a really nice portfolio. Or even, what we can see in the local market here is a lot of interest in community living, buying together a beautiful piece of land, putting cottages on there, have like beautiful areas and living spaces together. How can we tokenize that, for example? And have pure transparency and ownership rights or economic rights together in this property is based on maybe even like other areas, some of them can use and others not. So tokenization can create transparency and clarity as well between tenants by themselves, but then also social housing, for example. Do we have like a 10% shortage because the government funding is short, but at the same time our expenses are higher? Can we invite the community to fund that gap, for example? There's different cases what you can do. What I wanted to say clearly, only because we are in Europe regulated as utility tokens. In the US, for example, we have a big marketplace operator in the US now, a developer, and they're doing security token offerings in the US, but also because of the nature of the assets they're building, they're big developers. So once you start funding tools for new investors, and they're also on a $1 billion roadmap. So they're just going a different approach. So there's this approach, and then there's the other approach, which is the direct asset tokenization. That's what we do mainly at Blocksquare. For example, our asset token, our property tokens are in Europe directly shown on the land registration. So we actually created a direct connection between the token and the property ownership. So when the property settles, in the case of itself, then there isn't a token buying of the market happen in the process of settlement. Otherwise, house, the property cannot sell. It's similar to a mortgage on the title. So we have the on and off chain connection, which is crucial for sale.
That's the problem with the bottom line, accidentally.
Exactly. So in the real estate, actually, the nature is a very, very good asset to tokenize because it cannot be moved unrecognized, basically. Well, it can if you can sell it and tell your token holders, and nobody knows, and years later you realize, hang on, that asset is actually not existing anymore in this company. But then you can probably take it to court because it's really also regulation. But we try to do this automatically, the direct connection.
I also ask technology on the LT solving a lot of important social problems with that and democratize wealth. How do you approach that from a bigger kind of perspective from a big bank?
Yeah, so I mean, again, there's the financial inclusion aspect, right? So that's really important. For real estate, for example, you can think of the models, the business models that can be enabled by the technology. If you look at welfare, if you look at social housing, as you mentioned, like Australia has a 10% gap. In many countries, they have a long line until you can actually get into social housing. If you can tokenize a rent-to-own model, for example, you start earning your social housing credits, and eventually you qualify, or even for
question between hype and real innovation. I think I have to go right back to the beginning of my journey, and I think we do a lot of good science. A lot of good science is done across Australia, some of it is directed by a clinical problem, as in my case, some of it is discovery science. But I get the sense that there's a whole lot of ideas just percolating in the swamp, and what we really need is a group of people who can actually see those ideas and join the dots to create something that is of worth. Because all too often they get put to one side and people have a pet that is theirs, and they're going to push hard and hard and hard in isolation. And I think the difference between an idea that's going to work and the hype is an idea that is connected. And if you're faced with somebody who's coming and throwing this hype in the middle of the room and giving it large, ask what are the connections. What's the problem it solves? It's discussed earlier. What is the base science behind it? What are other people around you? The network that you work in that's making this happen. They're the questions you ask, because I mean, absolutely, I believe in tissue regeneration. I am still working very hard at the coalface so that we regenerate rather than scar repair our skin and other tissues as well. And we moved that dial a long way. But I learned early on, I can't do that on my own. And in the context of innovation that is going to make a difference at the bedside, you have to take that idea, you have to shape the science down, make sure you can bottle it and deliver it reliably, transparently, etc. And then you've got to connect with people who understand the IP, the governance, the reimbursement, the marketing, the sales. Oh, and what about the development? And Marie and I went to Welshpool and found somebody who would make a moulded plastic for us in a shape that is still the shape of the resale kit now, nearly 30 years later, and still use the same dye. But we recognised we can't do that. And then we have to go to the electronics people in Go Medical in Subiaco, who were making syringe drivers, and say, can you do the electronics for this? Because we can't do that. And CSL, oh, you're the best enzyme people in Australia. We want you to work with us. We're a small little port in WA, but to get them to work with us, I ended up raising funds for a lyophilizer that was delivered to them. And they ring me and they go, oh, we've got one to you, yeah, but we've got a machine here. I said, yeah, no, that's present. Now he can't see the room. Yeah, so we've got to do it. And so they still got that. And so the difference between something that's going to change the world overnight is the network around it. Multidisciplinary, interdisciplinary, lots of heads, lots of cognitive capacity. And then money. So the way that we get there.
It's a good setup for today's session.
And so when I say it took me 18 years to get FDL, that's partly, probably 80-90% because of the restriction on funding, the difficulties at every step. So, but a lot of good people around, and a lot of good people helping, but it was always risky. Well, the biggest risk is that you don't take risk. Because is this as good as it gets? Is this where we're going to end up? Is this what we're going to hand over to our children, our grandkids? Because that's not what my dad handed over to me. He didn't hand over, 13 years old and a boy stand down the corner. We think ahead. We think about what could tomorrow be. How could we heal in space? I have no idea, but I know we can take the blinkers off and engage in different conversations. So we have to have these conversations because, really frankly, we have to overcome our complacence and we have to go for it. Because we've vested here, we've vested in our space and our kids and our grandkids.
But that journey was 2 points so down. And it took so much longer than it really should have because of that access to capital. So I'm absolutely privileged to join the guys at Pacific Channel. What a deep tech venture capital firm started in New Zealand. We're now 4 funds in. We just launched our Australian fund, and we're looking to grab that sort of technology that is solving these amazing problems of humanity, medtech, health tech, ag tech. But the funding is so hard to that. We've got an ecosystem here in Western Australia that invests in risky assets. And venture capital should be part of that portfolio. We invest in money, right? We've got the whole capital stack in there. You can be a prospector, you can be one of the biggest companies in the world. If you go to Silicon Valley, you've got that in tech. You've got the uni students and the professors and the academics working on things like we have here. But you can also be the biggest company in the world. And that end-to-end capital stack should be our goal. We are 2% of Australia's venture capital, which is 1% of global venture capital. Just pause on that for a moment. So what do we do? What do? We bootstrap. We go to our friends and family. There's a really big problem there, right? As venture capitalists, we know that 7 out of 10, depending on how good we are, we might be a good picker, we might do better than that. But failure is part of the game. Can you afford to fail with your mother-in-law's superannuation? Or your best mate, or your sporting club, your friends? Can you afford to lose their money? The answer is obvious, no. And yet that's what our ecosystem does. And so that squashes innovation. Venture capital is needed. And not just a few. Again, use the Silicon Valley example. The best founders are chased. There is competition from the investors, which then means there's a really broad base of investment. And that's what's needed when you have such a high failure rate. The reason it works is the successes are massive. So if we're able to solve really meaningful problems and all of the network and the learnings that come from that help us put these things together, we need it here. We need to stop exporting our innovators like we export our others.
Great to be here at Blacksmith Summit. Great to be back at UW. So I graduated from here in the late 90s. I can guarantee that the supervisors did not have a 360-degree proceedings. Quick, just before I answer that question, let me just give a background. Half my life here in Perth, half my life in Asia. Within that half in Asia, half in Hong Kong, doing IPOs for Chinese companies, and half co-founding a VC and growth focused firm called OpenSpace. We've raised over $1 billion of capital. We've deployed in over 80 companies, and thank you for mentioning, we do have some big successes on the ledger, and also quite a few failures, to Brad's point. And that's really what I would love to talk a little bit about today, right? I'll answer the question around how to allocate by sectors, but I think our job as VC managers is to convince the big end of capital allocation talent, the LPs, that we can diversify their capital across multiple opportunities, and we can find at least a handful of winners. And we can get a few base hits, and cumulatively, you can make money out of this particular asset class. Don't make the sports club invest. Don't make your family members invest. Invest in a VC fund, potentially using people's super that could actually diversify the risk and create the right opportunities for a long-term return, as well as funding more Fionas, finding more of those people, being able to get 100 ideas, 1,000 ideas, a Cambrian explosion of innovation can only happen if you can allocate the capital. And so I think it's exciting to be here as we start talking about some of these things. The Black Swan Summit has been amazing, but I've been incredibly impressed by the talk about innovation, impressed by the quality of the science that is happening, including in the deep tech side. But I've been unimpressed by the lack of capital allocators in the audience.
Hands up if you are a capital allocator. You might not want to.
And they said, we'll give you your first check as long as you go out and raise even more capital than that from the outside, and that money effectively comes to Singapore. And we'll let you do your job, diversify, and then we expect, if you're successful, that we'll be able to bring more capital from various sources. But you need that catalyst, you need that stimulus to fund more of the talent that can then allocate to more of the innovation talent on the ground. Let 100 or 1,000 or 10,000 entrepreneurs give it a shot, but do it through a diversified structure that makes sense for the big end of town. Long introduction to answer your question. I think that the VCs need to have their own angle, how they can add value. So Brad has his angle, how he brings things together. People will have different specialties in terms of their sectors. But I believe there's a place here in Western Australia for West Australia-focused innovation. If we can just diversify more checks across this particular landscape, it should stay broad. It's the same thing we did when we got up and running in Singapore. We can do everything from ladies e-commerce all the way through to semiconductors. We could do quantum, we can do AI, we can do blockchain related, we've got strategies for all those things. But sometimes we'll make money on the most mundane and basic innovation-driven technology companies, which are focused on big end markets. And so the key is to make sure the industry is self-sustaining, is to make sure that first wave of VCs focus on Western Australia and make money for their investors in whatever form or fashion makes sense for them. And that could mean deep tech, it could also mean less deep tech that makes money at the end of the day.
So perhaps market first rather than tech first.
I mean, that's from our perspective, there's a role for different sorts of investors.
Yeah, so we're a hedge fund, and in one reason, just in there going, what am I doing on the stage? I'm a hedge fund. So, I mean, our hedge fund essentially compounds Bitcoin on a monthly basis. And it's not this world, but I love technology. And I've arrived here because I love the space of technology, everything to do with digital assets. But I've quoted 4 companies on the Australian Stock Exchange since 1987. Advanced composites, civil engineering, pharmaceutical that we work with Fiona on in regards to synthetically generated antibiotics. And what we've seen during that period of time, since 1987, is I've seen the West Australian ecosystem not change since 1987. And so to give you an idea how you navigate around this as an entrepreneur, you're ruthlessly focused on success. So therefore you work out where the money is and how you get to it in whatever it happens to be. So in 1987 when we listed a company called Eagle Aircraft, and we designed and developed an advanced composite aeroplane, we faced a change in regulations and we couldn't find any money in Australia to do it. So we ultimately joint ventured with the Malaysian government, which was a difficult transaction to say the least. And that joint venture saw the creation of Composite Technologies Research Malaysia. And we taught their workforce how to use advanced composites in a novel way. They're now the 5th largest advanced composite manufacturer for Airbus in the world. And they're turning over around $2 billion a year. That was our little company in 1987. So we moved through that, and then we turn around and we create something like QuickStep, which was an advanced composite curing methodology. And we struggled to raise money. So where do you get your venture capital money in Australia? Well, there was only one venture capitalist in Perth, one. And he maxed out his $6 million well before we got to him. I mean, it was Toy Town. And I said, right, well, where do we get this money? We listed on the Australian Securities Exchange, second listing. Well, I've got to tell you, Australia uses the ASX like it's a venture capital fund. And I describe it, it's like getting dressed naked every morning and all these people watching you. And the reason why is because they want a news update on your development program at the end of the week. Because that'll keep bumping the price up. Because they need the price to keep bumping so the brokers are involved so that you can do your second round of fundraising. That's not how development works or research and development works. It takes time, you make mistakes, things go wrong, you reinvent yourself. And in fact, we did with that company. And in 2009, some very tall fellows in uniform turned around and slapped us on the shoulder and turned around and said, would you be interested in producing the underbelly panels for the Joint Strike Fighter? It was a $900 million transaction, and we're this tiny little company. And of course we said, oh yes, of course. And why did we have that? Because we were the only independently owned advanced composite manufacturing company in Australia, because the other two were Boeing, which was the competition to Lockheed Martin anyway, they didn't want to use them, and one other group. So in other words, this tiny little company got this enormous contract, and it's now moved from Australia to New South Wales, because New South Wales said they wanted us and they'd pay us a great deal of money to move, so we did. And it employs about 370 people now manufacturing parts also for the C-130 and a whole variety of other things. And then as we keep rolling through, each one of these stories relates to the fact that it takes a long, long time to raise a small amount of money to get your development program up and going. So Fiona and I just exactly, if you want us to get there and do it quickly, give us money. If you want us to just dribble along, we'll survive because we're determined, we're entrepreneurs, we'll make it. So how do we fix that problem? Well, I've sat on the investment committee for the Perth Angels for a number of years, business angels, for a number of years, and I've also actively sat on the panel of the Private Wealth Network, which is a family office environment, so I sort of swap sides of the panel on that. And that gives two perspectives. It gives the perspective of what the startups are trying to achieve here in Western Australia and what the family offices expect when they invest. Family offices don't want to lose money, so they're not really angel investors until they become very sophisticated and large, and they've got a small percentage of their portfolio they'll dedicate to it. Otherwise, you can generally not consider family offices an investment area. What worked best in the 37 years that I was involved with startups was tax concessions. It was just like the champagne float. And all of a sudden, if you had a tax concession where large organisations could argue the proposition that what you were doing was synergistic in their world, then they would get a 200% tax deduction on engagement, and they'll get a very small tax amount on the success of the business. It became